Good morning, good afternoon, and welcome to Webcast with the management of MPC container ships, hosted by Arctic Securities. My name is Jo Ringheim. I'm a shipping analyst at Arctic, and I will be moderating the webcast today. Together with me, I have the CEO of MPC Container Ships, Konstantin Bak. MPC Container Ships is a market-leading container ship company specializing in the feeder segment, owning and operating one of the largest fleets globally. We look forward to learning more about the newly recapitalized company in a rising rate environment with new interesting trading patterns. So we will go through four main topics in today's presentation. We'll start with the container market dynamics, then move on to rates and rate developments, then look at trading patterns before we look at the implications for MPC. We'll conclude the webcast with a Q&A session, and the total duration will be around 30 to 40 minutes. You are all invited to ask questions for the Q&A in the webcast window during the presentation. So if we start with the container market and the dynamics that we're currently observing. Konstantin, how is the current state of the container market, and how has this evolved over the past months with rates improving quite significantly since the summer?
Yes, first of all, good afternoon and good morning also from my side. Thanks for joining us today on the webinar on the state of the container market and MPC container ships as well. Obviously, 2020 has been a very, let's say, extraordinary year and has so far shown two phases. One is obviously affecting COVID, and I would like to run to one of the slides here to show that slide 3, where we basically see the developments in terms of drop in demand. We have seen a period beginning of the year where we have seen good volumes, decent charter rates, etc. And then between March and basically July, we have seen the worst volumes in history in terms of drop. However, that has changed, and most recently, and you can see that at the top of this slide, between June and October, we have seen a significant improvement in terms of charter rates and idle fleet globally, which is in terms of the steepness of that recovery also basically unprecedented. So I think that is worth noting when you look at the container market in general, especially at the utilization of the fleet and charter rates. Likewise, if you look at the liner industry, obviously the liners started the year with quite some positive support from kind of the market outlook. Then we have seen the drain in volumes, and everyone was extremely concerned about profitability of liners. However, the fact that there was very, let's say, prudent capacity management as well as the low fuel price, of course, has led to a situation where liner profitability has been extremely good for especially Q2 and Q3 and also for the full year of 2020. So overall, the market has coped quite positive, if you want so, in terms of the recovery and the stability with the COVID situation, which obviously was extremely uncertain over the course of the period between March and July. So that's probably a starting point in the discussion here. If I may just jump back on one of the previous slides here, where we basically also see the different trade lanes here on slide 2 and the different sizes, and I think that is very important when looking at container tonnage providers like ourselves and also liner companies. You see the different sizes, feeders, Panamaxes, Neo-Panamaxes, and ultra large container vessels serving different trades and different routes. And I think this especially going forward, is a very important consideration when looking at the different sizes and certainly trades. What we have shown here is basically the number of ships, the TU and the different sizes, and obviously also thereof charter tonnage. So what part of the fleet is actually owned by operators like Maersk and Hapag, and what part of the fleet is actually owned by charter tonnage providers like ourselves. And at the same time, I think it's extremely critical to understand the share of the total TU traded in terms of relevance of the different trades at the very bottom. So the last line on this slide, where you see that intra-regional trades make up 42% of total volume, which underpins the importance and the increasing importance of intra-regional trades over the last couple of years. Over the last 8 to 10 years, it has come up from around 1/3 to 42% in terms of relative share in total TU. And that is also why, at least in our view, it's extremely important to look at supply and demand. And demand is basically the different trades and development of those trades. And the supply side is, of course, the number of ships, the age profile of the ships, and of course the order book. That just as an introduction from my side to the market and the market dynamics most recently. If I then may just quickly jump into the different sectors again on this slide at the top right, where you see the differentiation between intra-regional intermediate trades and the different vessels employed. So this is vessels below 5,000 TU that are dominantly part of the trades here or employed in these trades. And the order book to fleet in that segment is at only 5.1%, which is extremely low. And at the same time, there's a fairly positive demand outlook. Obviously, demand outlook has always to be seen with a bit of caution in a world where we have seen over the last 24 months 2 disruptive events, being the trade war implications on container trade, as well as obviously the COVID pandemic. But generally speaking, with that slim order book, if the demand outlook comes in as it is currently expected based on IMF outlook, we expect a significant rebalancing for the intra-regional and intermediate trades in terms of supply-demand balance. On the main lane and long haul trades, also at the top right lower box, you see that the dynamics in terms of order book to fleet as well as demand and supply outlook is slightly different, yet also that segment is at the moment fairly balanced, with volumes having rebounded quite significantly.
And as you're pointing out, the volumes have rebounded markedly. And this has, in fact, benefited all the different container size segments. Could you explain a bit how these are moving together and fluctuating together, and where MPC is positioning?
Absolutely, and I think a good chart to look at is chart number 4, where you see the time charter rate developments. This is now really focusing on the vessels employed in the intra-regional and intermediate trades. You can see at the top left, basically 2020 rate developments, obviously a reflection of what I have just mentioned in terms of significant drop and then significant increase again. And basically the counter position is on the top right, where you see the idle fleet. Let me explain that in a bit more detail. Of course, as of March, we have seen increasing idle fleet and increasing or decreasing rates as a result of the market disruption. And now that has increased significantly. And if you look at kind of the idle fleet on the top right that we have seen going into 2020, which was around 250 vessels across sizes, and I'll get to the specifics of our segment in a minute, we are now at 140, so significantantly below the levels that we have seen going into this year. And back then the rate level was fairly solid. However, given this drop in idle fleet, we have seen a correspondingly increase in charter rates. And that you can see on the top left for the different sizes. So between June and today, the larger vessels have picked up a bit earlier. You can also see that when looking at the curves. And that is basically related to the availability of tonnage, right? Smaller ships are usually on more flexible periods, meaning they can be redelivered more quickly in times where charter rates are short. However, over the last couple of weeks, we have seen that also the durations and the flexibility of charters for smaller vessels has decreased. And you can see here, for example, 2,750 TEU vessel, dark blue line, to 12,250. We are currently looking at charter renewals, certainly north of that, more in the vicinity of $13,000 up to $15,000. So the market has increased significantly. The larger vessels are basically taking out of the market for the rest of the year because simply no charter tonnage will become available in the next couple of months. They have all been chartered out in the period between July and today, the vessels that would come open this year. So there's quite a dynamic in that respect. And we focus on the smaller sizes because we believe, looking at demand and supply dynamics, the intra-regional and intermediate trades are the trades where we see the most promising demand development in combination with order book, age profile, and flexibility of vessels in a market that has certainly way more focus also on regionalization and redesigning of supply chains, which in my view will have a significant positive impact on flexible vessels.
And then moving back a bit and understanding how the market works, and because you touched upon tonnage providers and liner companies, could you explain who are your customers and how are the market dynamics working and impacting the different parts of the industry chain?
Of course, I mean our customers are the big liner companies plus regional operators. We currently have around 38 different charterers on our fleet. That means we have quite a deep, let's say, network which goes beyond, let's say, the top 5 liner companies. So we have various regional operators in addition to the big liner company, which in all likelihood differentiates us quite a lot from other tonnage providers in the industry. So we, for example, have a fairly frequent turnover, especially in a year like this, where we have been redelivered on various vessels. In terms of charter renewals, we have already this year done more than 140 charter fixtures on our fleet, which is a significant number and shows the, let's call it, industrial character, but also the fact that this year we have basically been floating with the market to some extent, going down and now going up with some of the fixtures I've mentioned for vessels where we have seen a significant uplift in charter rates. And the driver as such are not just kind of feeding into the hubs and centralizing and decentralizing cargoes to the hubs going on the main lane east-west trades, but also real regional trade. We are the largest tonnage provider in the Caribs and Americas related trades. We are a significant player in the intra-Asian trade and intra-Europe. So these trades are our core regions where we operate and where we have our customers. And obviously interesting is the latest development that we are now also seeing longer periods for some of the smaller vessels at certainly or much improved rates compared to the last couple of, let's say, last 24 months, where we had certain disruption in services and people stayed rather short also on the charterer side. But now there is, given the supply and demand dynamics, an expected scarcity of assets, unless, again, there's another disruption on the demand side. And on that basis, there's also more appetite to lock in longer term charters. And with longer term, I mean rather 1 to 2 years, not 5 years or anything in that vicinity, by regional operators and in particular liner companies.
And talking about the market developments and the increase in volumes, which has been driving rates and economics up. A key question for me as an analyst, and I guess for you as a company, on how to deploy the fleet going forward and take the different decisions, the outlook. And a key question there I would like to ask is, are the trends and the increase in volumes that we're seeing, are those sustainable, or are those does those come as a result of a catch-up effect with volumes now needed to be transported after the low activity seen this year?
Well, it's indeed a good question, and that's obviously one of the key questions in taking decisions. I think it's fair to say that there is certainly an element of catch-up, but also an element of changing trading pattern and changing, let's say, also volume pattern as such. We have seen, in fact, and I think everyone is aware of the so-called cascading effect, where we have seen slightly larger vessels eating into smaller trades to some extent. We have, in fact, seen a reverse cascade on some of the trades, which is attributable to a shift in certain trading patterns, and especially the rise of some of the Southeast Asian economies and trades in and out of these economies. So I think part of that is catch-up if you look at the US and restocking in the US, but also part of it is related to real shift in pattern, and hence more, let's say, ton-mile demand, if you want so, and additional services that have been opened, and that can be evidenced by the way you look at the idle fleet, and also the term of charters that has extended to some extent. So I think overall it is a healthy development. There is, in my view, going forward, a trend of regionalization and reshuffling of supply chains, because people don't want to be caught on the wrong foot again, in case another disruptive event happens in the years to come. So in my view, there is also a structural element to this shift. Hence, it's not a pure catch-up effect, but it's also related to a shifting trading pattern to some extent, and also solid volumes. I mean, as I said earlier, volumes between March and June, July have dragged down this year's demand growth into basically into a negative. Whilst at the same time, September, August figures are already above, on most of the trade lanes are above prior year's levels, which shows that it is a sustainable trend, in my view. Obviously subject to another disruption, as I said earlier, and in addition, I think it's also worth mentioning that usually in September, early October, prior to Golden Week in China, you would see a softening of the market, and this year around, and the opposite is the case actually. We see a bit stronger rates and continuous drop in idle capacity.
The slide that you're showing on the screen now, up to the left there, seeing rates improving this much. Is that something you are getting on your vessels? And can you also explain the dynamics about chartering out vessels and being a tonnage provider in the space? How long, for instance, would the normal charters be?
That basically depends on region and size, but I think to bring it into somewhat digestible form, on some intra-Asian trades, we're currently looking for slightly larger feeders. So let's say above 1700, we are looking at up to 12 months, and actually looking even at some longer terms. And there the rates are actually above the levels shown here on the Clarkson side, because as always, indices lag behind in good and in bad markets. So we are certainly looking at rates that are at the moment above these levels. That's one element. So the larger the ship, the more likely you can get a slightly longer charter. On some of the smaller units, it's simply by nature of the trade that we will probably get something up to 10 months, but more in the vicinity of 3 to 6 months. And this year we have obviously been a bit running behind the market given the extraordinary circumstances and the challenges in chartering out vessels during the period between March until June, where there was basically a complete lack of visibility on the liner side, and hence a complete lack of appetite to enter into something longer. And if they were to enter into something longer at rates that were unacceptable. So I think we were able to keep our charters short this year, keep the vessels afloat. If you compare utilization on our own fleet with the market, for example, August, September, we look at utilization of 94 to 96%, which is extremely solid. And we're looking at increasing charter rates until year end, and that's dependent on minimum or maximum redelivery windows. We will have to renew 25 up to 37 vessels, again depending on the redelivery. Obviously, in a market like this, I would expect that charterers keep the vessels as long as they can at the low rates that have been locked in the past. So there's let's say a smooth rollover of charters, but again, 25 vessels are still up for renewal until year end in any event, and there we will certainly see a significant improvement in rates and in charter fixtures as long as markets stay where they are and we don't have another significant disruption.
Moving on to trade patterns, and you've been discussing this a bit, but can you explain, maybe looking mostly at the intra-regional trade, but how is your fleet positioned, and have you seen any change in the trading patterns after the low volume seen earlier this year?
Yeah, maybe we can jump to this slide, which shows a bit of trading pattern. Just briefly, so everyone can digest the slide from left to right. On the left-hand side, we see total vessels. It's above 5,000 container vessels globally, and they have been basically mapped to different trades. So more than 50% are actually involved in intra-regional trades, and that's number of vessels now. 27% in intermediate trades, and then around 20% in the main lane trades. So most of the ships by number are employed in intra-regional trades. And if we then look at the dynamics in those trades, we have drilled down here the intra-regional trades in the middle pie chart in terms of TEU capacity. So looking at kind of up to 3,000 TEU, 3 to 5,000 TEU, and larger vessels, which obviously is negligible in a sense, but around 2/3 of the volume is actually still basically being run by vessels in our size cluster. So feeders up to 3,000 TEU. And if you then look at the right-hand side, you can see that there has been a bit of a shift in trading pattern. And one element is what I mentioned earlier, that we have seen, in fact, a reverse cascade this year. If you look at the different, let's say, the legend and the different colors, you can see that the vessels above 7,600 TEU that have kind of been part of the intra-regional trades have actually disappeared in 2020. And we have also seen, in relative terms, a increase in the vessels below 3,000 TEU. So the workhorses in intra-regional trades are, and in my view, will remain the smaller vessels. There's obviously always a shift in trading pattern. There's a bit of upsizing of certain trades, but as we have evidenced this year, and as I said earlier, volumes have increased in total, at least in August and September compared to prior year. We can actually see a very strong growth over the last 6 to 10 years, and in all likelihood going forward for intra-regional trades based on this. And I strongly believe that flexible vessels will continue to be in preferred demand going forward in a market where the trading pattern is quite dynamic at this very moment.
Thanks. And moving on to the company specifically, you've been through a successful recapitalization this year, strengthening the balance sheet and extended maturities. How should we look at MPC, for example, from a cash flow perspective, by looking at where rates are now versus where they are coming from?
Let me jump now. I think this is the right slide to at least give a part of the answer. As you rightly said, we have run through a recapitalization basically in response to the unprecedented market situation and unpredictable outlook that we were faced with over summer. So there were different ingredients. First of all, the main goal was to ensure a significant or substantial liquidity runway to address the market uncertainties and market risk. And we basically carried out a private placement, which was a key ingredient, and have obtained some support and concessions from our credit partners, and thereby boosting the pro forma liquidity and the actual liquidity as such, in order to make sure that even in a corona rate environment, and back then that meant for our fleet around $6,500 to $6,700 per day and vessel blended over the fleet, was kind of back then the market environment with actually low utilization. Today, obviously that runway is significantly extended given the market uplift, and now we're looking at almost $2,500 to $3,000 blended over the fleet in the spot market, higher rates, which is obviously a significant increase that only occurred between the month of July and today. So on that basis, liquidity runway and securing liquidity runway has been one important effect, and I think that is extremely key. Secondly, waiver of covenants to address covenant risk. Obviously, in a market like we have seen in between or around April, May, I mean, predictability of asset prices was also extremely challenging, and hence we wanted to make sure that we stay in compliance with our covenants, and or we at least get waivers on certain covenants where simply the unpredictability of the market had to be addressed, and on that end we also have certain kind of waivers of covenants, which obviously today the market has changed a bit, is something that is good to have. But obviously with the improved markets, we are confident that we're on the right track there as well. And lastly, we have extended the maturity of our 200 million senior secured bonds into 2023. In anticipation, or at least in absence of the fact that we basically didn't know where the market would lead us. So I think these have been three key ingredients in terms of liquidity runway, waivers and maturity extension that we believe have been necessary in light of the unpredictability, and from today's perspective obviously have been have strengthened the company to be in a position to benefit from the market recovery that we are currently seeing.
Regarding values, have you seen any developments or changes there, given the recent improvements in the market?
Asset values and charter rates, I would say at the moment are a bit decoupled, and the reason for that is that I mean, everyone is still, and you raised that question earlier as well. I mean, how sustainable is the volume development? How sustainable is the charter rate development? And I did mention a few aspects why I personally think that there is we're on the right track here in terms of sustainability of that trend, subject to another disruption, obviously. But having said that, asset prices are somewhat lagging behind at this very moment, and that is because people don't know how sustainable the rate recovery will be. Having said that, if we are now able to lock in longer term charters for some of the vessels, obviously this will evidence the sustainable recovery, because our customers and partners might then be willing to pay up for having vessels for a prolonged period, under their control and under their operation. And if that is done at significantly increased rates, that will inevitably also lift asset prices. So I would argue there is an uplift in asset prices can be expected, obviously linked to the degree of uncertainty that might be observed going forward.
So finally, how should we think about MPC going forward? I mean, you're now starting to generate cash based on the market levels that we're seeing. Of course, some uncertainties out there. What will be the strategic focus for the company in the next 12 to 24 months?
Yes, let's just quickly spend a minute on the cash flow situation, because I think that is important to comprehend when looking at the strategy, right? I mean, at the moment, if you look at this slide, kind of cash flow and deleveraging capacity, which in my view are key elements when looking at the way we conduct the chartering side of things, and the ability to generate cash flow to delever potentially the company and or accumulate cash. So we are on the left-hand side, you see the cash break even normalized for some extras, one-off scrubber investments that we had still in the books in the first half of this year. And then on the right-hand side, you see in different charter rate scenarios from left to right, the actual Q2 TCE that we have seen as a company in the second quarter, then followed by kind of pre-COVID levels according to Clarksons for our asset basket, and the current rates, if you look at the Clarksons October rates, which is pretty much in line with what we have actually accumulated or earned in 2018 as a company. So I think overall that shows that there's a significant kind of operational leverage with every $1,000 in additional TCE generating around 20 million in EBITDA or free cash flow. So I believe this is important to understand. Strategically, we will continue to kind of seek at least at these levels to get a staggered deck of charter coverage in our book to bring a bit more yield into the company. On that basis, we believe that on the supply-demand dynamics that I mentioned earlier, there will be, if the demand stays where it is or actually increases even a bit over the next 1 or 2 years, that we will see a tighter market. We have very limited ordering activities also due to the fact that people are uncertain about the right propulsion, certainly for smaller vessels. And we will certainly think about ways to optimize the portfolio as well. We might be a seller of one or the other asset in the smaller sizes or some of the older vessels, and given that asset prices still lag behind, potentially reallocate some of the funding to slightly larger vessels, 2.8s, maybe 3.5s, etc. So I think that's at least something we will focus on going forward. As I said, delevering is key. There's a significant operational leverage if you look at these figures, and we believe that will be the way to benefit from what I expect will happen over the next couple of months and years ahead, which is a market recovery.
Makes sense, and thanks for explaining. I think we should wrap it up and thank Konstantin for taking the time. If you have any follow-up questions, either to me at Arctic or to Konstantin and the company, just let us know. Any concluding remarks from you, Konstantin?
Yeah, maybe just to wrap that up. I mean, so far, obviously, 2020 has been an extraordinary year in various aspects. Most significant drop in volumes in history, actually, and related implications on volumes, charter rates, etc. And then followed by a very strong recovery, also in terms of volumes and charter rates. So I mean, we are in a position, we have taken various measures to be able to weather the storm, and I think now we're pretty well positioned to benefit based on our operational leverage from an expected rate recovery going forward. Of course, provided that the political and pandemic, let's say, related landscape does not lead to another severe disruption on the demand side. But overall, especially for smaller and maybe also mid-sized container ships, the supply-demand dynamics look extremely favorable. And on that basis, I see a significant upside, both in terms of rates and asset values going forward. And appreciate to receive some comments in that respect. And thanks, Joe.
Thank you, and with that, again, thank you, Konstantin, for taking the time, and thank you to all of you listening in. Yeah, have a great Tuesday.
All right, thank you.